There's a new casual dining king in town. Hello, this is Jonathan Mays, editor-in-chief of Restaurant Business, and welcome to The Week in Restaurants, a weekly discussion on the biggest news in the restaurant industry. And I'm here with RB senior editor Joe Guskowski, and we talk about the new largest full-service restaurant chain in the U.S. and why it's gotten there. Hint, the company will not surprise you. We also talk about the other end of the spectrum, the unfortunate history of former Brinker International restaurant chains and more economic upheaval. Later on Tech Check, Joe talks about first-party ordering. But first, there's a new casual dining king in town. Joe, you care to enlighten us on who that is?
It's Texas Roadhouse.
I'm shocked.
We knew this was coming eventually. I don't know if I expected it to be this year, but it was, they're the clear leader at this point, jumped past Olive Garden on 14% sales growth, while Olive Garden grew just less than 1%. So Texas Roadhouse has been doing this for a few years now. They've really just surged coming out of the pandemic, and they're opening a lot of restaurants as well. And so that pushed them into the top spot.
Yeah. Texas Roadhouse, I got some data in front of me, Joe, so I'm prepared, unlike most of the time.
Boy.
So Texas Roadhouse did $5.5 billion in U.S. system sales last year. Since 2019, they have added $2.5 billion in system sales since 2019.
That's amazing.
They've basically doubled in size over that particular period, which is amazing considering that there happened to be a pandemic in the middle of it. And here's what I'm going to say. Like, we've been talking about Chili's a lot on this podcast and in my other one, A Deeper Dive. And for good reason, they had an amazing 2024. But Chili's Texas Roadhouse basically does that every year. And what Chili's did last year. And their success has been so automatic that we basically just come to expect it. And I think, much like Chili's, and frankly, by the way, one of the interesting things is when you hear Kevin Hochman talk about where Chili's should be, he always talks about Texas Roadhouse. And when he was in Louisville, when he worked for KFC, he and his family used to go to Texas Roadhouse all the time. And that is the chain that he thought of when he took the Chili's job. And he kind of realized that there is a formula for success in full service restaurants. And that formula is not really all that complicated. Focus on service above all else. And, Kent Taylor for years was super anal, not even focusing on takeout, because he did not want his customers to have substandard food. And he felt that if people are taking that food home with them, that's going to make, the wait between the time it's cooked and the time they eat it, it would diminish the freshness. So he had that. And then the company just really, kept things very simple. The menu is a relatively simple menu. And of course it's steak, Joe. Steak chains are all the rage.
Steak has done well. And they've taken this position of, everyday value. They don't do a lot of discounts or that sort of thing, but they keep the prices reasonable. They've priced below inflation over the past couple of years. And I think that's part of, consumers have responded to that, and they've rewarded them with traffic, and then they're getting a good experience when they go. And it's really that simple, but not always easy to do, I guess.
Mm-hmm. Yeah. It does help that consumers like steak coming out of the pandemic. Mm-hmm. And that's been one of the more fascinating because, beef prices have been going up quite a bit and people really like steak. It tends to be one of the bigger no-brainers in the restaurant space. And if you look at some of the higher end, you got some weak higher end chains like STK and whatnot. But on balance, steak concepts have generally done well. I mean, at Darden, Longhorn Steakhouse has been a pretty consistent performer. Maybe not in the neighborhood of Texas Roadhouse, but their sales went up 7% last year. They've been a very consistent concept. Outback Steakhouse has had some issues, and I think some of the issues that we're talking about kind of accentuate some of the challenges there. But I also did more math, Joe, earlier today, preparing for our upcoming top 500 coverage. And steak chains in the top 1,500 restaurant chains last year grew sales 7%, whereas the entire casual dining sector grew sales just 1.3%, and total sales in the total chain restaurant sector grew 3%. That's a top 500 preview for you there, Joe.
Well, a steak is something that you kind of have to go to a casual dining restaurant for, or fine dining. You're not going to get it at fast food for sure, and probably not fast casual, although Chipotle and Sweet Green are putting it in their bowls, etc. But you're not going to get a nice steak unless you go out for a sit down meal. So it's sort of a competitive advantage.
Yeah, it is. It's definitely a competitive advantage. And now, McDonald's, you can get steak at breakfast at McDonald's, with their steak, steak, egg, and cheese bagel, I think. And, here's a little thing for you. That bagel there is like this entire group of devoted fans to McDonald's steak bagel. And when McDonald's last year brought it to my market, Minneapolis, some restaurants had it early. And people that are part of this Facebook group, there's this entire Facebook group literally devoted to McDonald's bagels. And so they flocked to this one restaurant, and there was like a 30-minute wait at breakfast because that restaurant, that McDonald's location, had steak bagels. It's weird.
Have you had it?
No, I haven't. I haven't. I can't get out of my house in the morning, and often enough to go to McDonald's for breakfast. As easy as that is, I mean, it's literally right down the road. I don't know about you, but I'm like actually most Americans. I have a very set routine in the morning, a very set routine. And I'm really hard for me to break that. If you interrupt my routine, I'm cranky the rest of the day.
Let me guess. It starts with 64 ounces of coffee.
No, the first thing I do is I usually go for a run. I work out, and then I shower. Yeah, I do. I get up at 5 in the morning, and I have to. It's the only time I can do that. And then, I usually fill this thing with coffee, and then I do it twice. So now this is a good on the other end of the spectrum, Joe. Brinker International. I went down a Macaroni Grill rabbit hole this week.
Sounds dangerous.
No, it is rather dangerous. You're familiar with Macaroni Grill, Joe? Did you ever go?
Never been.
Yeah. So I was down a rabbit hole on Macaroni Grill because I looked up their top 500 numbers, and they closed more than a quarter of their locations. They're down to 21 units. They're owned by the same people that effectively ran Old Country Buffet and Hometown Buffet until they literally died a sad death. And that's, is the same executive team now owns that company. And I kind of realized something. Brinker International has sold 3 restaurant chains, Joe. All 3 of them have filed for bankruptcy. Macaroni Grill, which has a weird distinction of having put 2 companies into bankruptcy, on the border filed for bankruptcy earlier this year. And I could have sworn they had filed before. That's terrible. I could have sworn they did it before. And then Corner Bakery. And the most benign of those 3, Joe, was on the border. Was a pretty classic. And you could probably guess as to why they filed for bankruptcy. Nobody eats at full service Mexican chains anymore. And, Corner Bakery, they filed for bankruptcy in the most spectacular fashions in 2023 because their owner didn't pay any of the bills. And then you go back to 2017 when Macaroni Grill filed for bankruptcy, and basically it's dying. And for all intents and purposes. But in some respects, it's kind of sad that, in Macaroni Grill and On the Border cases in particular, there's sort of remnants of, casual dining chains of the past. When they were in their heyday was the heyday of full service casual dining. They were, Corner Bakery is Corner Bakery, and that is what it is. It was never quite lived up to its expectations, and then was unloaded when the pandemic and during the pandemic, and then was basically mistreated. But On the Border and Macaroni Grill were thriving chains in their heyday, and then they started falling, and then Brinker unloaded them, and then private equity firms just sort of did the rest, frankly.
Yeah. Sort of a recipe for bankruptcy.
Mm-hmm. Demand for full service obviously has really plunged. 2/3 of visits in 2019 were for takeout or delivery. That is now up to 3/4, and that percentage has been going up for years and years and years and years. And there's just a smaller pool. And frankly, I think the lesson here, people will go to full service chain restaurants, as a Texas Roadhouse example demonstrates. But companies that can't really, that just lose favor with consumers, don't get the investment and the attention that they need, start making compromises, consumers are just not going to do it. If you're not doing what you're supposed to do, if you are a full service concept, you are making your life infinitely harder.
The stakes are just so much higher when there are fewer visits to go around. You got to be on your game, and that's what's creating the winners and losers that we're seeing.
Yeah. Hooters is a fascinating story on that. We've talked about Hooters now a couple of times because they've gone, they've filed for bankruptcy themselves. But now, you've got a bunch of major bankruptcies, this year among full service restaurant chains. And, and Hooters also was a thriving chain in the 90s and early 2000s. Their marketing was on point, and they've just never really been the same since they were unloaded. TGI Fridays has been never been the same since they were sold by Carlson companies. So it's really difficult, I think, for these chains when they get owned by companies that just focus on the bottom line all the time. And it's not an area. This is not an era in which you can do this on the cheap. But usually these companies end up loading these. The private equity firms or other owners will load these companies up with massive amounts of debt, and then they can't do anything after that.
Yeah. It will be interesting to see if some of these brands can bounce back. There's so many that are now in turnaround mode, both the bankrupt ones and others that are basically trying to revitalize these dead concepts. And I'm just fascinated by whether that's going to be possible.
You have any hopes for any of them?
I think Hooters has a good chance. They have a differentiation with their concept being the restaurant, and they've got some good operators in the system who are now taking over. So I think that one's got, maybe of all of them, that one's got a shot. Fridays is tough. There's a lot of concepts like Fridays, including Chili's. So I think the competition is stiffer in that segment.
Yep. Yeah. I think I'm with you. I actually like, most of the time these companies go file for bankruptcy, and then they have a bankruptcy plan, and the bankruptcy plan usually involves, most of the time, it involves a sale process. And, that sale process usually puts the company into the hands of, some investor who thinks that they can get a restaurant chain for cheap. And, and some of these investors are better than others. There are a lot of, and I know a number of them, and they have, they have really good intentions to do really good by their concepts and make it work. But a lot of them are aimed at just trying to get a quick buck, and then usually what happens is that they cut the hell out of costs, take out whatever cash they can, and then while it's still operating, and then just sort of let it go until the next maybe they end up filing a Chapter 22 a second Chapter 11 bankruptcy, which we call Chapter 22, or Chapter 33 or
Guys, math.
44. In the buffet situation, I think I counted it was Chapter 55.
Are you serious?
Yeah, they had 5 bankruptcies.
It's got to be a record.
Yeah. Oh yeah. Very between all the different companies. 4 of them were for the company known as Buffets Inc., or at one point Buffets LLC. And that was a company, Joe, that was created in 2006 when the parent company of Old Country Buffet bought Ryan's. Ryan's, they were all buffet concepts, and Ryan's was based in the Southeast. The Old Country Buffet, Hometown Buffet, was in the Midwest and in the West, and created this big national buffet behemoth. They took out a massive amount of debt right before the Great Recession in that company, and within just a couple of years, it ended up pushing that company into bankruptcy. They lowered the debt in that scenario, and that just lasted a couple of years, and then they had to file a second bankruptcy. They ended up getting sold to one of these investors, and then this investment group, and basically ended up, they would buy more of these buffet brands on the cheap, and they filed bankruptcy a couple of times. And then they bought a company that also filed for bankruptcy in Furs, Chapter 55.
I think they would have learned their lesson after, 2 or 3 of those.
Yeah, but the problem is, the challenge, I think, with the bankruptcy process is the bankruptcy process enables companies to, it's aimed at protecting the assets and paying off the debt. And, so it can incentivize substandard behavior, frankly, in which, companies are, they just can continue. It takes a lot. These companies aren't going away. And, there's usually an incentive on the part of the bankruptcy court to maintain the company's, to keep the company around as much as possible. Very rare. Most of the time, Chapter 7 doesn't happen very often. There's always, and you can structure it in a manner that you can actually keep control of the company after the bankruptcy filing. So, yeah. So that's what happened. Speaking of challenges, Joe, I hope you haven't looked at your 401k lately.
Nope.
Yeah. So we've had a lot more economic upheaval. Frankly, Joe, I watch the stock market every day because that's my job, and my neck hurts from watching it go up and down all the time. It went down 10% last week. There was one moment, I think it was on Monday, in which stocks plunged on the open, like they'd been doing pretty much every day since Liberation Day was announced. Stocks just plunged, and then there was a news report that there was going to be a 90-day pause on the tariffs. Somebody on Twitter, on the social media program formerly known as Twitter, quoted this report that he'd seen, and stocks immediately shot up like 1,500 points, like a ridiculous one. It went from down 1,000, the Dow did, to up 500. And then the White House quickly denied it. So it went back down again. And then earlier this week, the 90-day pause was announced, and then the stocks went up 2,000 points, I think, yesterday. And then today it's down 1,000 points again. And most restaurant stocks have been hammered, probably putting some financing into question. Nobody's going to be able to go public anytime soon. Sorry, Inspire Brands, you're not going public. But it's been a bit of a challenge, and there's a ton of uncertainty, particularly with the tariffs. What have you heard have you heard anything from your concepts at all about the potential impact from tariffs?
I think, there's kind of 2 big impacts. One will be the impact on supplies. If you're getting food, materials from tariffed countries, is going to hurt your bottom line, and you're going to have to, overhaul your supply chain again, which you probably just did a few years ago because of the pandemic. That's a concern. I can't determine yet whether that's a bigger concern than the potential impact on consumers, who are already suffering from years of inflation and now possibly going to see prices go up yet again, which would hit their discretionary funding and make them, think twice about going out to eat. I don't know that we have an answer on which of those is kind of scarier, but either way, it's not good. I suppose this pause gives people a little bit more certainty, but we don't know what's going to happen after that.
Yeah. Well, I mean, it's first off, I am fully on the view that the bigger concern is to the consumer, especially the tariffs the way they are now. No, there's a couple of things. I mean, first, the lowering of tariffs to 10% outside of Canada and Mexico, which are still paying 25% for a lot of goods, still problematic. It will drive some prices up. And I do know that the uncertainty about tariffs is probably going to put a number of ideas on hold. The bigger concern so it will drive up costs and they'll have to raise prices. It's a bigger problem, I think, for grocers because they have a higher overall level of food costs. And China we do import some food from China. It's just not that much. The Canada and Mexico tariffs were the worst from a food importing standpoint. There is a concern to me on development, because now all of this equipment and these appliances, a lot of the goods that we get from China are electronics and things like that. Things like everything from Happy Meal toys to food and equipment we get from China. And I think those tariffs were up. They were 145% now, which is insane. More than doubling the price of those goods. It's cheaper, by the way, if you've imported stuff from China. It's cheaper just to let the goods sit in the harbor or at the dock than it is to actually import it. Just let it go back. But it's going to drive up development costs. But it will drive up food costs to a certain extent. I think that restaurants can, it's going to be a couple of percentage points on the bottom line. They'll have to raise prices, which they will probably have to do that. I'm a much bigger concern about the state of the consumer, because the consumer entered this year in pretty bad state, and now we're piling more uncertainty on top of it. You're watching what's happening with stocks. You're right on that part. Consumer is by far my biggest concern, and it's going to be something to pay attention to. Going to be a big issue.
This next round of earnings calls will be very telling.
Yeah. Kurisushi mentioned something about tariffs, but it was largely on uncertainty. Nobody knows what's going to happen. And even the pause was just a pause. So we could be revisiting this again in the June, July timeframe. But,
can't catch a break.
No, they can't. All right. Fantastic. Well, thank you, Joe. Coming up next, Joe will talk about first-party ordering on Tech Check right after whatever ad our esteemed podcast editor Spoons sends you now.
Are you looking for a new podcast that provides practical tips for running your restaurant business? Do you want to hear from the food service world's most influential decision makers? Then go subscribe to my podcast, Takeaway with Sam Okus, which features everyone from the CEOs of the biggest restaurant chains to the leaders of small but mighty emerging brands. At the end of each interview, I provide my takeaways from the discussion, giving you actionable insights that you can take with you on the go. Go subscribe to Takeaway with Sam Okus wherever you listen to podcasts.
Hey everyone, welcome to Tech Check, where I, Joe Guskowski, talk really fast about one big topic in restaurant tech. This week, some good news about first-party ordering. Restaurants have been trying for years to get customers to order through their own websites or apps, rather than through third-party apps like DoorDash or Uber Eats. It has been an uphill battle, but there are now signs that those efforts are working. A recent report from tech supplier Q found that 40% of restaurants believe first-party digital orders will be their biggest growth driver this year, by far the most of any channel. Elsewhere, William Blair reported that first-party digital orders were the most common ordering method for the second straight quarter. This comes as restaurants have been investing heavily in things like loyalty programs, mobile apps, and other tools to strengthen their first-party business. And it suggests that customers may be starting to see the value in ordering this way. They can get a lower price for one, and they might also get some perks from a rewards program while they're at it. To be clear, third-party delivery is still popular and growing, and those apps can be a good way to get customers. But first party remains most operators' preferred channel because the margins are better and they get more data. So, needless to say, it's encouraging to see things trending in that direction.
And that should do it for The Week in Restaurants, which was edited, as always, by Spoons. Artwork by Nico Hines. You may find this and other episodes of the podcast on our website at www.restaurantbusinessonline.com. But please subscribe to Apple Podcasts and Spotify. I'm Jonathan Mays, the editor-in-chief of Restaurant Business. Thank you for listening.